Ridham Desai of Morgan Stanley. Here we are on day 2 of the Morgan Stanley conference. And Ridham is as excited and charged up as ever. Pleasure to have you here with us, Ridham. So tell us, how's the Josh at the conference and otherwise?
Yeah, no, the Josh is high. There's a lot of interest in India, except that it doesn't actually convert into flows, which we'll come to later in this conversation. But yeah, there's a lot of interest. There's no doubt that people need to understand India from multiple angles. See, I'll tell you how these things have changed. We've been doing this for 27 years. Yeah. So many years ago, people would come because they had portfolios or they were looking to buy stocks in India. And they had to check on companies and understand the macro. That has now changed to the extent that, of course, that people do that for a living and they have to do it. But they also need to understand India from a global perspective. Yeah. So you're not now just coming to India because you have a couple of investments in India. You're also coming to India because India is moving the world. You know, as I've recently said, the world may not slip into recession this year because of India. Now, it's important to know whether India is going to do well or not, because if India is not going to do well, then the world may have a recession, which is going to have implications on everyone else. So I think India's stature in global markets and in global macro has completely changed in the last 10 years. And we're now significant, we're important. People need to understand this country, even if they don't have investments here. So that is the change.
Before we talk, the usual earnings, valuations, and the market targets, just describe to us India's place in this new world, at least for the next 3.5-4 years, till we have the present US dispensation in place. There's a lot of talk about whether India can, quote-unquote, seize this opportunity as a dislocation in global supply chains. Do you see that happening? I mean, industrial is a sector that, for instance, you're overweight on. What does this new Trump order, global order, mean for Indian companies? And then, therefore, we'll talk about their stock prices.
See, Surabhi, the decision on setting up a local manufacturing facility in India, I don't think has much to do with the tariffs that President Trump is proposing. A lot of these plans were already underway pre-April, and I don't think are changing dramatically because of the tariffs. There may be some delays because people want to have clarity, and that is exactly why global growth is slowing down. Because companies are pushing back on their investment plans, just waiting to see how the environment pans out in the next few months. That aside, there is really no impact on these investment plans. India is still a favored destination for what we call as China Plus One. And one of the primary drivers for that is what I mentioned earlier, that India's home market is very critical to a lot of multinational corporations. You look at the industrial companies from Europe, and they're all telling you that India is going to be a big driver of their growth. You look at the electronics sector, look at phone companies, India is a major part of their growth, and likewise. So that has not changed on April 2nd. So that story is continuing, and India will continue to attract. That said, one thing which we need to bear in mind is India is not becoming the next China. I don't think the world has appetite to create capacities like it did in China in the last 20 years. The unfortunate thing is that the world is heavily indebted and is aging. And therefore, growth on a structural basis for the world at large, ex-India, is likely to be a whole lot slower than it has been in the last, say, 15 or 20 years. And therefore, the appetite to build large capacities is not there. But the appetite to diversify supply chains, the appetite to build facilities in India to cater to India's home market, that's clearly there. Okay. So India's manufacturing share of GDP will rise, but you should not be holding your breath for the next China. It's not happening, in my view.
Which is fine. Take your point on that. Then let's talk about earnings. And I think in your latest review, you do speak about how, because of a confluence of a lot of positive factors, you're expecting on a sustained basis, mid to maybe even high teens earnings growth. And I think that's a little above consensus, going by other estimates on the street. What makes you confident that earnings are coming back?
I'm never confident. I'm always skeptical. but we are in an earnings upcycle. Very simply put, earnings tend to move around the nominal GDP trend. The nominal GDP trend in India is largely a straight line, except for the COVID dip when things turn a little bit bad. But that's those rare things that happen. And earnings, of course, do this. So earnings don't go up in a straight line, and we are somewhere here right now. Trend line GDP is here. Okay. So this damage happened between 2011 and 2015. Earnings fell well below trend. And now we are playing catch up. And then again, we got a bit of a setback during COVID, and now we're playing catch up. So the likelihood is, and it's very simple mathematics, earnings will catch up with nominal GDP and then go above it. And then that will be the peak of the cycle. I think we're somewhere halfway through that cycle.
We're still away from that peak.
Yeah, we're somewhere halfway. We consider the COVID bottom as the start of this earning cycle, though I do think the earning cycle started slightly before that, but COVID has distorted the data. So we are somewhere halfway through that, and it is largely driven by a slow and steady rise in capex. And the reason why this cycle looks more durable than the previous one, which was from 2004 to 2008, is that capex is not going to go up like this. So in that cycle, what happened is capex went up like this and then came down, right? So earnings also went up like this and came down. This time it's more good. I think it's more likely to be like this. Also, a lot of people are saying, oh, there's no capex in India. The reason I think they feel that way is because the nature of capital spending has changed. Yeah. We're not going to now build the massive steel and cement plants that we saw in that era. Again, a lot of the capex is being written off on the balance sheets. It's not been actually capitalized because that's the nature of capex. And most importantly, in the last 10 years, there's a technical term called incremental capital output ratio, which is how much capital do I need to create 1 unit of output. That amount has actually fallen because India has become more productive.
The other factor has been the technical factor of supply of paper. We've seen massive blocks and massive promoter and PE exits in the last few weeks. How do you read that developments, and is that a red flag according to you?
So, Nilesh, 2 things I'll say. Is that most people thought that if the mid-cap index fell 20-25%, retail will run away. Yeah. So first of all, let us accept that retail is not a short-term player. Sure. And if you talk to people, really large distributors on the ground, and you should interview some of these people because they have a far better handle on the retail sentiment than the people who are actually managing the money. Yeah. Yeah. Okay. So they will tell you that retail in India is not looking at their prices every day. They're not your audience. Yeah. They're buying the stocks and just going to sleep. Yeah. Okay. And that's, the average holding period, I've done this computation, of Indian retail investors is 36 months. Yeah. Nowhere on the planet do any class of investors hold stocks that long as the average investor in India holds.
And I remember you saying this for many years now, that the retail money is very sticky and it's only going to surprise on the upside.
Yes. So that is done. Okay, now as far as supply is concerned, yes, we had a little bit of bunching up, but that was in 2023. Okay, there was a bit of a bunching up that happened, and then things
eased. Even now we are seeing this, 4-5 deals every day.
But you have to add up the numbers and you have to divide it by the market cap. Sure. So whatever number you see, whether it's a weekly or a monthly number, if it's a monthly number, multiply it by 12 and divide it by market. Yeah, sure. That number, if it starts crossing 2.5-3%, then I will get worried. What is 2.5-3%? It's $10 billion of issuance every month for 9 to 10 months on the trot. Oh. We're not there as yet.
You're not there as yet, of course.
We are going to get there, but we're not there. When we get there, the market will have to correct, because I think that will then exceed the bid on stocks.
I'm going to come back to that first point that you made, right? And you asked that question before we could, which is that when are these foreign investors coming? Because the narrative is strong, the macros are strong. And there's this big shift about diversifying away from US assets, right? Yeah. But where will we figure? Because China is a great competitor, and maybe the argument is they have valuations on their side.
So the China valuations have always been on the Chinese side for 25 years. There's not been a single year in the last 25 that China traded at a premium to Indian X stocks. Okay? Yet, in the last 25 years, India has handsomely beaten Chinese stocks. So if you invest in stocks looking at P ratios, it's a disaster.
Yeah.
Price to earnings has nothing to do with value.
Is that what you're telling the foreign clients?
No, I'll explain this to you. Give me a little minute. Give me a little time. So price to earnings is just another way of expressing price. You can express price in US dollars. I can say this is worth $6. Then I can say it's like worth half a gram of gold. I mean, its price. Its price is 500 rupees, or its price is 5 times earnings. Value is something very different. It's about a company's ability to generate cash flows and what expected return I have from that. So the reason I can't explain this is because a lot of the tourist money is also very lazy and wants convenient thumb rules to make their decisions. And very wrong. Okay, you look at private sector banks in India 25 years ago. They all traded significantly higher price to multiples than today. Yet for 20 years, they were amongst the best performing stocks in India.
Yeah.
If the starting point of price to book or price to earnings is going to determine what return you make, then I think then investing would be a very easy game.
Yes.
So it's not so simple. In my humble opinion, and it's not even humble, I think stocks are cheap. Okay? Stocks are inexpensive in India. I wrote that day before yesterday. My title of my report is Equities are inexpensive. Bond yield in India, 10-year bond yield is 6.2%. The equity yield is 5%. India is a growth market. The gap is minus 1%. This is cheap.
Yeah.
Look at Nifty in gold ounces. Either gold prices fall or Nifty goes up. It's cheap.
That's refreshing. Indian stocks are cheap. We don't hear that every day. So to complete...
So the reason I'm saying that is because as a consequence of the policy decisions that we have made in the last few years, we have dampened our inflation volatility, which therefore means we have dampened our interest rate walls. And if interest rate walls are low, growth walls are low.
Yeah.
Equities thrive in a predictable growth environment. If you can figure that a company has a 20% CAGR in growth for the next 5 years, you will pay 60 times earnings for it.
Yeah.
You're not going to say, oh, 60 is expensive, because predictability of earnings or predictability of dividends, to be more precise, is the trickiest thing in equities. It's not the issue in bonds. In bonds, you know the coupon and you know it exactly for how many years. So there's no valuation debate in bonds. The debate arises not only because of this, that your forecast and my forecast on cash flows is different.
Now that's
justifying the bull.
That's the India bull, turning the valuation argument on its head, and that tells me why.
It's logical as well.
It's not about turning it. This is not a spin. This is the fundamental reality.
It's perhaps a different lens.
Now, see, I can go wrong on my cash flow forecast. And that's why I will go wrong on stocks, not because they're trading at 20 times earnings.
That explains why the 1 lakh target on the Sensex is intact, the bull case. All right, Ridham, fantastic conversation. Thank you so much for taking out the time and being with us.